Our next panel focuses on sustainable finance and capital markets innovation. As sustainability becomes increasingly integrated into real estate strategy, capital markets are evolving to price climate risk, social impact, and long-term value creation. From sustainable lending and ESG data to new financial products and reporting frameworks, finance is playing a central role in shaping how real estate responds to global challenges. This panel brings together leaders from finance, data investment, and academia to explore how innovation in capital markets is influencing sustainable real estate decision-making.
Good afternoon, everybody. Today we will look at how sustainable finance and capital markets innovation are shaping investment decisions and the flow of capital in real estate. To start us off, I would like to Professor Stefanescu answer, what does sustainable finance mean to you, and why is it important for students not only to study finance and development, but also to engage with environmental, social, and government side of real estate?
So I'm not gonna, as an academic, I cannot tell you how I define it. I'm gonna say how the academic side defines sustainable finance. So you can think about making financial and development decisions that have not only a long-term perspective, but also in addition to focus on returns and maybe profits, also you're thinking about some of the environmental impacts or social outcomes, and of course governance. Now, from my perspective as a finance professor, actually what's more interesting, I'll be very frank with you, is the use of the ESG in whenever you create portfolios, whenever you manage portfolios, it's how do you use these ESG metrics. I was always fascinated by this because we use on a daily, I mean, most of the companies, the big companies, they need to use these ESG metrics, and I always thought it's all about the G, but there is some E and S in those metrics, and the question is, how do you actually measure them? It's a measurement problem. It's a consistency problem. For example, one of the most interesting places that I see is that I would like to see a standardized reporting, something that does not vary by company or by company that's reporting, something that actually does not change every year. Because if you think about one of the main questions as an academic you want to answer is, for example, is ESG, or firms that have a higher ESG metrics, do they perform better in terms of profits, in terms of returns to their stockholders? This is a very important question, but you cannot analyze this unless you have you have consistency across time, and across company on these metrics, because we want to make the case that ESG is important, but to make a case that ESG is important, and you took my class in stats, we need to have the data, the right data. Now, of course, the studies, I can tell you, the academic studies, they're very mixed. It's a mixed bag. Some of them show that yes, ESG is important in terms of company performance. Some of them say no, it's not as important as we think. But I think that's not the main idea behind sustainability, if you ask me. Sustainability, I think it's extremely important. All of us should, I mean, that's why we are here, because we do believe that sustainability is an extremely important subject, and of course, as Dean Norman said, unfortunately, real estate industry is one of the most polluting industries that we have out there, and so studying sustainability for students, is very important. And I don't see it as a standalone class. I think it's important to study sustainability in almost every class that you take, because you need to understand. So, for example, you need to understand where the industry is going, So you need to understand sustainability in your development process. You have to understand sustainability in your corporate finance class, because that's where you talk a little bit about the governance, So you need to, so the way for the students, it's important for them to be exposed at all the stages, because reality is that sustainability is important, I mean, we face some very, very big risks, And how can you guys know how to price these risks if you don't understand where they come from? So that's my 2 cents on what students should know about this.
I think this is a great perspective. And to build on that, Paul, Building on the broader framework, how do you define sustainable finance and how does it operate within established credit and return frameworks at a larger institution like Wells Fargo?
Great, good to be here with you all. So Wells Fargo, sit in commercial real estate, and we're a commercial real estate lender. So all my answers will come from the perspective of a lender, not an asset manager. And so I think later in the panel we'll get a bit into how do sustainability characteristics get incorporated into kind of business as usual underwriting. But I've heard folks say like the sustainable finance labeled market's dead, and I kind of disagree as an opportunity to provide some additional transparency. So, were there any corporate green bonds issued last year? Not really outside Equinix in the U.S., but we did have a really busy year at the securitization level. And so I guess I'll break sustainable finance labeled market into two buckets. One is use of proceeds, so a bond or a loan where the borrower is providing additional transparency into the sustainability characteristics of the asset to potentially get some additional investor eyes on the transaction, improve liquidity, or get additional banks on board the deal in a loan context. And then the other category is around sustainably linked. So a corporate or a fund that is committing to setting annual targets to improve a sustainability metric each year over the tenor of a loan or a bond, with the potential for a pricing ratchet, a pricing improvement if they achieve that target, and a pricing detriment potentially if they don't achieve that target in a given year. So use of proceeds, sustainably linked, in addition to sustainability just being incorporated into the kind of plain vanilla underwriting that we do, with definitely some work in progress still to come. Those two labeled structures exist. And to answer the second part of your question, everything has to fit within the kind of the business as usual bank risk-adjusted return model. For those that aren't familiar, deals at banks, and I assume Northbridge is similar, you've got to go through a capital allocation committee to make sure you're meeting proper returns. You've got to interface with credit to make sure that credit risk is tight. Having a sustainable building or a sustainable structure that doesn't fit within the traditional risk-adjusted return structure, credit guidelines, return, it's not an excuse. It's nice to have, but it's got to meet kind of the underlying criteria as well.
What are some examples of sustainable finance that not just increase disclosure, but also impact investor-led appetite in real estate? Maybe Laura could also jump on that.
Sure. Yeah, I'll start. So I started to answer the second question with the first question, I guess, in that not a whole lot of corporate REIT green bonds last year, particularly in the U.S., but the securitization market has been very, very active, and going above and beyond just saying we've got a nice office building that's LEED Gold or LEED Platinum. So the way a green bond works is you create a sustainable finance framework within the transaction documents, and you provide additional disclosure around things like embodied carbon, green building certification, projects that are expected to improve not only energy efficiency, but also expenses over the coming years. You get a second party opinion, like an external validation on that framework, and then green bonds get marketed alongside normal bonds, but we put additional focus on reaching sustainable focused investors, which again, I think most folks care about investing, or should care about investing in efficient, well-run buildings. But latest Morningstar stats, so there's about $700 to $900 billion of sustainable focused funds out there, not excluding bad stuff, but really trying to integrate efficient buildings in there. And so with these green bonds, and we structured about 15 sustainable securitized green bonds, primarily for office and data center last year. We do get feedback from investors that I was able to, at times, to increase my order size because I was able to allocate to these additional funds, or this impact reporting that was provided as part of the transaction helped me comply with this massive $1 billion pension fund mandate that I won recently. So the cost is not that much more. The time investment is not that much more. We try and do a lot of the work for our clients. it's tough to isolate what the exact greenium is, but we do at times see increased liquidity, investor diversification, folks being able to put money elsewhere. And so that's an example of, it's not just disclosure. Folks want to do this because they're ideally going to get some benefit out of it. And when I'm talking to bankers internally, it's not help me get a green bond. It's how can I partner with you to help get more eyes on this transaction for a client, to hopefully help create a better outcome for them and help incentivize them for some of the sustainability measures they put into their property.
So to add to that, in terms of from the finance side down to the developer side, or even, in between, there's an economic benefit, sometimes with Zagrenium, as Paul was talking about. But one of the things we were all talking about prior to the panel starting is actually the collateral. Building a better building, call it what you want, actually improves the value of the collateral. And it might not be today, it might be the next buyer or the next buyer's next buyer, but putting in the better HVAC system, putting in the better windows, it could be for hurricane resiliency in Florida, could be for reinforcing your concrete against seismic resiliency on the West Coast. It could be just putting in new windows in New York City and changing out your PTAC units to heat pumps to reduce your OpEx burn, which improves your NOI and is good for everybody and also attracts tenants. So it's really thinking about, and when you think about finance from the sustainability side, and when you think about building the sustainability side and what you'll be able to afford, the way I like to think about it is, what are you building? And call it what you want, but if you're actually improving the collateral, you're creating value. Or you may not be creating value, but you might be maintaining value and not seeing value destruction. So C-PACE financing, I'm the founder and CEO of Northbridge. We're a national C-PACE lender and servicer, and we focus on financing every asset class and providing financing so people can afford the sustainable capital improvement to the building. That's another metric in addition to green bonds that people can now access today throughout the country.
I was just going to add an additional thought. We were talking about this sort of in our quick informal prep session earlier, but both of you mentioned it. So I'm with Measurabl now, new to Measurabl over the last 3 months, but prior to that I worked for the Energy Star program at the US EPA for 20 years managing that program. And over that time, I think what we've found to be true, just in talking with lenders, investors, owners, was that being a sustainable building, in particular for us being an energy efficient building, started to become a proxy, really, for having a well-run building, a well-managed building, a well-maintained building. Yes, you might get eyes on the project or something, and you can use the sustainability or the energy efficiency or the Energy Star certification or LEED certification or whatever to get some additional eyes on that project, maybe some other benefits. So that was just going to be a positive. But in the end, it all comes down to what is that asset, right? And how is it performing? What is the long-term outlook? And you don't get, especially in places like New York City with a lot of older buildings, you don't get to have a highly energy efficient building unless you've done some really good work. It's not just putting the technologies in, it's how are you then operating, maintaining it. One thing we haven't talked about at all here is how are you interacting with the people that are using the building, right? The residents, the tenants, the shoppers who come in. In the end, they're the ones who actually use the energy in a building. It's not the building that uses it. So it just is a more broad indication, I think, of this is a good asset overall. Call it sustainable, don't call it sustainable, it really doesn't matter in the end.
Yeah, but at the end of the day, you're just thinking about something long-term. If you focus on the long-term, that's where value is created, yeah? And so making sure that you have the right building, then that makes sense, yeah? As a collateral or also as a source of revenues, yeah? I mean, that's the whole idea. I think profit maximization works. And I think sustainability is actually part of it. You cannot disregard this. Yeah, I mean, this is one of the. I think sometimes maybe this has a bad rep, but it's not true. I mean, if you build well, if you take care of some of this risk that you have, it means that you're pricing correctly, which means that your valuation is correct. So from an academic point of view, you cannot leave all these things aside. Yeah, as a finance person, you have to think about this, how you can actually deal with all these risks, yeah. And by the way, all the let's say financing institutions, yeah. At the end of the day, what they do is it's almost like capital. I mean, it's almost, if you think about what they do, they just try to understand the risk they're taking. Yeah, so they can do capital rationing. They can say, oh, we're not going to lend to these guys because we think they should also take into account. So I think it's going beyond this ESG label or metrics. It's understanding a little bit exactly what does it mean, yeah, and what are the impacts. And I mean, maybe 10 years ago we were talking about climate change as being something in 50 years. I think we're getting closer. I think we're getting much. I mean, the discussions have changed quite a bit if you think about for the last 5 to 10 years. So we see the impacts now.
You know, I was just going to add too. There had been some studies that were done in this area back in the late 2000s, early 2010s. A professor named Niels Koch had done a number of them with some others. That, to your point earlier, that looked at Energy Star and LEED certified buildings and evaluated them as far as rental rates, occupancy, and asset value, sales prices. And they found over many studies over several years a correlation between all of those. So again, I think they're using those as a proxy. Those studies, interestingly, have sort of stopped. There hasn't been one done, I think, in the last 8 or 10 years or so. I think because there were so many done that they felt that that was proven. But one thing to your point earlier, I just want to touch on is they showed that there was correlation. They couldn't show that there was causation, right? Which would be better if we could show causation. Correlation is still valuable and important, I think, for what you guys do in looking at buildings and deciding, is that going to be a good investment? What are we getting out of that, right? It's better than nothing. But we viewed it as a positive thing that those studies have stopped. And he and others who were leading those studies have moved on to other issues now.
Yeah, so just in terms of correlation versus causality, for my knowledge, I remember one very good, I forgot what journal it was, but good corporate governance does matter. And it actually, there was a very famous study that shows that companies that have very good, good corporate governance in terms of boards, everything that they do, management, things like that, they were outperforming by 8% a year the companies that did not have at the lower end. So that's actually a very powerful thing when you can actually show that returns to the stockholders are so much higher when you have good corporate governance. Yeah.
Absolutely. I think, Laura, you mentioned CPACE before. Could you briefly explain what is CPACE and why its adoption accelerated meaningfully in recent years, and how does it drive the creation of more sustainable assets?
Sure. So CPACE stands for Commercial Property Assessed Clean Energy in most places, but the new term is really more clean Commercial Property Assessed Capital Expenditure. We pay, and many of the new programs that are adopting CPACE legislation, it's now available in 40 states. We actually just closed our first CPACE deal in New York City, first multifamily deal ever done with CPACE in New York. So it's really the adoption is becoming much more widespread, and the reason I mentioned the newer programs are adopting the capital expenditure idea is that we pay for upgrades to buildings. When I first heard about CPACE, I'm a New Yorker, a very proud New Yorker. I looked around and I said, where is the solar panels and wind turbines in the city? And the answer is, there aren't, but there's many use cases, such as your entire building envelope and all of your building systems, i.e., as we were talking about before, all the things you're going to do to your building as a fiduciary, whether you're a borrower or a lender or both, you're going to want to build something that will maintain the asset value and you improve your collateral. And so we will fund renovations and new construction for any asset class. We also have the ability to look back up to 3 years from what's called the TCO of the project and be able to lend money, what we call retroactively. So we can also be a meaningful part of a stack of a refi or rescue capital, passive liquidity injection. We're paid out through taxes. We are a tax assessment. And so we transfer with the property. The innovation that we have seen is a couple of things. One, it's now become, throughout the country, it also has a tremendous amount of liquidity. The pricing has come down, and the size and scale of deals has drastically increased. 3 years ago, the average deal size was under $1 million, and now it's $40 million. And Northbridge, as a lender, we focus on institutional borrowers and lenders in major markets. So we start about $10 million, and the bigger, the better for us. And what we're finding is most people don't know they can use it. because the use case used to be very small and now it's grown. And as we see both a pullback of banks and dislocation in the capital markets, PACE is coming in as a very effective form of capital to bring down the cost of capital, enable borrowers to get the proceeds they need to go forward with their project, complete their project, or recap their project. And we're also seeing that as people have built good projects and can benefit from the look back, we can come in as a meaningful part of a refi. So we've very happily worked with Wells Fargo in the past, and banks and debt funds are all learning about how to use it, and that allows people to build a better building and a better project. It can also be used on a standalone basis. The project we just closed in New York, we are paying for 100% of the hard and soft costs for electrification for a multifamily asset for Herald Towers on 34th and Broadway. 690 units. They are reducing their energy consumption by 35% and have 9% savings per annum. And we're able to pay for all of the costs going into this particular project. So while it can be, you'll see large banner headlines about, $100 million or $400 million project for construction, it also can be really effective to achieve the electrification needed by a local law 97, or pick the other 20 plus cities and growing that have measures that are requiring building owners to upgrade their assets. So we are enabling people to achieve the upgrades necessary, whether required by law or as a good builder and a fiduciary to help bring tenants into your building and keep them there, which is great for everybody in the stack combined.
Even with evolving frameworks and better information, where do you still see misalignment between capital markets, property owners, and operators? Question open to everybody. Would like to start.
I'll jump in quickly on that and defer to my other panelists. Education. I started my life as a lender and then spent a significant amount of time being a developer. And I thought I knew a lot about sustainability and what was out there, and I was really wrong. The market has evolved so quickly, and there's so many great tools, whether it's green bond financing or Measurabl being able to understand the data. And as products are evolving, education is paramount to let people know what they can achieve from a financing perspective. Again, most of the conversations we have, people don't even know that they can get the financing for CPACE. They think they have to be passive house and net zero. And while we love that, it's not really capable or possible in every market. And so in many cases, if you are a really strong builder and you're building to or slightly better than code, which most institutional groups will do, you can qualify. So it's the understanding that you can access these things, and then also the understanding that you can access these great products, that you can reduce your operating expenses and you can make small changes which can have a meaningful impact on quality of life in a building. If you're in an older building in New York City in Midtown, and I was in one of these, we've just moved and love my new space, we had leaky windows and steam heat. In the middle of February, we're opening the windows and we're also blasting the air conditioning. That's not good for anyone. So if I say to somebody, again, call it what you want, if I can fix give you new windows and better heating and more efficient, cooling, not only is it better for the tenant, so a great measure to attract tenants into your building, it's also really good for the bottom line of the borrower, and it's great for the lender for their collateral. So I think it's about understanding what you can access and how you can make small changes. You don't have to tear down the building. You can. There are tangible things that can be done even on a smaller scale, like at Herald Towers. They're doing an awesome job to make it much more effective for people.
I'd say that there's another thing, talk lack of education about these opportunities. I think that's 100% there. And then I think there's sort of another version of that, which is there's almost too many programs out there in a way. It's going to sound a little bit strange maybe, but it came up on one of the earlier panels that there are so many different programs and opportunities out there in terms of funding and whether it's discounts or rebates or grants or whatever, depending on who you are, that it's incredibly hard to keep up with them and to even understand what opportunities are out there, even if you do want to know. On Unfortunately, a lot of the federal ones that I was involved with have now gone away or are going away. That is unfortunate. But I think, in particular, if you're not a large owner, of Class A buildings, and you don't have a staff, and you don't have energy managers or sustainability managers or people in finance who are looking at these things and aware of these things, if you're a smaller owner, you're just not able to even take the time to figure out what's out there that can benefit you to implement those projects, right? So how we solve that, I don't really know. I mean, there are some great things going on. There's like New York City and some of the others that have these new laws, the building performance standards, have hubs, resource hubs out there to try to provide this information. But it's still just a bit overwhelming, I think, to a lot of people. And it also goes over their head a lot, too. It speaks in a way that they don't necessarily understand. So I think we have to find a way also to better communicate with people about what opportunities there are and help them understand it and help make it easier to access.
Absolutely. And as Measurabl sits at the center of how sustainability data is collected, standardized, and shared across the real estate industry, from your point, where does sustainability data meaningfully influence capital and investment decisions today? And where does the gap between measurement and action remain the largest?
Yeah. So I was thinking about this question, and I have to say, too, that I am the non-finance guy on the finance panel here. I come from a pure sustainability background. Is anybody else in the audience pure sustainability? That's where they came from? Okay, just a couple, not many. But what I have been all about for the last 20 years in my role with Energy Star, managing the Energy Star portfolio manager tool, was data. And so I did think it was worth stepping back a little bit and doing a little history lesson. I joined Energy Star back in 2004, so just over 20 years ago. The program was already about 5 years old. At that time, the real estate industry didn't see energy as a controllable expense. It was generally seen, for the most part, as an uncontrollable. You get the bill, you pay the bill. And that was it. It was what it was, right? I think my colleagues who started the Energy Star program decided that probably wasn't necessary. It probably shouldn't be the case. And they started trying to get people to benchmark the energy use of their building, measure it so that you can't manage what you don't measure. So they launched this tool, tried to convince people in their existing buildings to take a look at how much energy your building is actually using, and then see if there are ways to actually reduce it. And because they knew that if you tried, you probably would find some ways to reduce the energy use of the building. And it didn't mean that you had to spend a lot of money to upgrade all the technologies. That wasn't what they were talking about at first. It was about operate the building better, work on people's behavior, sometimes fix things like if you have steam and you have the windows have to be open, go ahead and attack that. But generally trying to prove to people that pretty easily, there was a lot of low-hanging fruit. You could reduce energy use in the building. And then once you get them to understand that, they're going to want to continue to track it. Then they're going to go ahead and they're going to do some projects and they're going to implement some technologies and upgrades. But it was, at the same time, just as important to keep tracking that and look at the data and always be looking at the data. Then as it all grew, and we had the green building movement, which really took over in the late 2000s, and in particular in new construction, we found the data was even more important because there were many stories, including a couple here in New York City, about LEED Platinum buildings that were built that were not highly energy efficient. And you guys probably remember those. Well, everybody discovered there was a reason, and this is, again, why it was important to look at the data. They didn't really realize that until they started looking at the benchmarking data. And they saw, hey, why isn't this building performing to the modeling and everything we thought it was supposed to do? And they ended up mostly being able to find ways to fix it. It was things that weren't installed properly or just not operating the building properly. So the data had really become just critical in the end, I think. And now I think when we look at investors and lenders and others, we're at a point where the next phase of this is going into effect. Things are really starting to happen now. We're sitting here in New York City. We talked about Local Law 97. Not sure, I assume most people are familiar with it, but I was chatting with someone this morning who wasn't. So with Local Law 97, I think it's something people have been talking about for a long time. This is a building performance standard, for those who don't know, that requires you to, in your buildings, meet a certain level of emissions. And if you don't meet that level, you're going to have to pay a fine. Sometimes it can be quite significant. So the first deadlines for that are this year. It's the first law in the country. These have been developed over the last few years. First law that's actually coming into effect. And now what we're going to see is which buildings are meeting those requirements. I think I read that about 80 to 85% of buildings are expected to meet these first set of targets. So that's good, but about 15% are not. And then there's new targets in 2030 that are about half as much as the current ones. So I think with the current performance, about 40% of buildings are currently at that level. So basically what all that means in terms of capital and where you're putting spending and what buildings you're looking to buy is you now have another data point that's very local. If you have a building in New York City, you're looking to buy a building in New York City, invest in buildings in New York City, whatever, this is something you should definitely be paying attention to because this is now real. Before it was theoretical, maybe it'll happen, maybe it wasn't, maybe the lawsuits will win that will stop it, that didn't happen, and so now it's there. And so if you're in that 15% that's not in compliance right now, you need to figure out what can you do to, where are you going to put your money? Are you going to put it into your worst buildings and get them into compliance? Are you going to put it into your better buildings and get them to keep up so they're in compliance with the next set of requirements? There's a lot of sort of different parameters and things to consider. So I think that's how we're going to see the data being absolutely critical, a new way, a lot of other ways, but a new way that it's going to be critical. There's about 13 jurisdictions around the country that have these laws in place right now, and more of them are developing them. I think it's only a matter of time till New York State gets there. State of California is working on one, so every building in California will be subject to one of these in the near future. So I think that's going to be really important to be thinking about not investing in buildings if you're looking to purchase a building. Make sure you know what that's going to look like in 2030 in New York City so you don't get hit with $1 million a year in fines, for example, or something like that. So it's going to have to be factored in.
Thank you so much for that insight. As we continue to see investment in large, high-profile, energy-intensive developments such as casinos, entertainment venues, data centers, and mixed-use projects, how are sustainability considerations realistically being weighed in financing decisions for this type of assets? And maybe, Paul, you could start.
Sure. They're certainly not a nice to have, and they're really a license to operate. I mean, think about a data center where there's some deals in market that it's like $25 billion in lending to develop a couple hyperscale projects. Think about it. If it's not at the right elevation or it's not built in a resilient location, that affects the viability of the project. If they don't have access, if they don't have like a waterless cooling technology, or there's risk of them not having enough water or depleting the water from the community, that affects the viability of the project. Access to power to begin with is challenging and certainly in the news, but ideally, as not a whole lot of the tech companies have certainly dropped their net zero or renewable energy commitments, access to some sort of cleaner or renewable energy is incredibly important. I mean, we haven't talked about the S a lot, but access to the community, it's hard to focus on what you're doing if the community's not happy and barking up your door. So making sure you're well established with the community, the site, you know, what was the site before, what's the site now, making sure that the site is taken care of and redeveloped in a responsible way. So yeah, we're all using AI. I know it has good connotations and bad connotations, and we're using it more and more and more and more. So it's kind of like folks that want to wish oil and gas companies away, but continue to drive internal combustion engines. We're all kind of feeding the fire, and I think sustainability is certainly important and should be a big focus. But in a lot of these cases, if they're not factoring in all of these things I just rattled off, plus a whole lot more, you're not even going to be able to get financing for a project.
So actually, coming from Northern Virginia, I can tell you everything that you're saying.
You're still buzzing.
So awful. So Loudoun County and and everything. But I do think capital is gonna. I mean, that's a big problem in Northern Virginia right now. It's a pretty big problem, and we have also a casino coming up in Tyson. So that's another good thing. But I think capital will flow there. I mean, I don't see capital not flowing there, but I think the more important issue is underwriting part. Are you underwriting these deals correctly? Do you understand? I mean, for example, now I hear, so just to get to the grid can take 5-6 years in some cases. So you have, location is very important. Everything is so, exactly. So I think that this is where sustainability really plays a crucial role, because it does have an impact on the community. I mean, prices do go up. I do pay a lot of money. Now I understand why my last bill was so high. No, I think this is exactly, I mean, this is very important, but it's underwriting. It's, if you do the right way, they're gonna work out, and you're gonna have a good outcome. Otherwise, no.
And those are good businesses.
Yeah.
So yeah, I would agree. And I think in this case, it's again a lot about the optics too, of sort of those benefits, that these tend to be projects that are very sort of controversial, right? Especially data centers. I live in the same area. I used to go ride my bike out in Data Center Alley, both sides, just data centers for miles and miles and miles. But most people are fighting these projects, right? They don't want a casino in Tyson's either. It's so I think the more you can do in terms of sustainability, the more it's going to look like the project is a bit better. And it's a tricky situation because these types of buildings, these types of assets are going to exist. We need data centers, much as we complain about them, much as we complain about how they're going to use more energy, they're going to drive up energy prices, everything else. They are, and they're doing that now. But they're not going to go away. And in fact, we wouldn't want them to go away. We wouldn't be able to watch our Netflix movies. We wouldn't be able to, do everything else. We wouldn't be able to use AI in real estate, right? So I think it's really important to just look at assets within their class in terms of sustainability and not think about data centers or casinos or anything else that are high energy intensity compared to warehouses or low energy intensity buildings. We have to look at each data center compared to other data centers. We have to look at casinos compared to other casinos and make sure that those are being built and operated in the most sustainable way possible. And that's what's going to give them the highest asset value when there's problems, when other community activists come around and everything else. It's going to help to sort of get those in place and get past a lot of those hurdles.
I want to sincerely thank you for your knowledge and insights. And before I open up to Q&A, could we please give a warm round of applause for our panelists? Does anybody have any questions?
Thank you so much for the great panel. I just wanted to ask a quick question, contrasting 2 points you made. First being that, of course, all sustainable projects have to fit within the typical risk profiles of real estate. And then also contrasted with the concept of the lack of education around some sustainable practices, especially more leading practices such as, say, passive house or mass timber that aren't quite widely as adopted yet. Is there, and then if so, how do you overcome any perceived increase in risk for these projects and an additional cost just simply due to institutional unfamiliarity around these sort of innovative methods? So.
Sure. So I'd say one area where, so yes, I did mention sustainability needs to fit within the kind of risk structure, return structure of the bank. One area where we've tried to be innovative, and I think get at what you're talking about, is a couple years ago we developed a green lending program where labels like passive house are part of. And with that, we tried to take the best of the Fannie and Freddie and all other kind of green label programs that are out there and be very rigid and ambitious about the criteria and say you built to passive house and then achieved and maintained Energy Star 85 or better over the tenure of your loan, you would get, and we acknowledge that's really expensive and we don't see really any of these projects at that level come across our desk. But if we did, because that would be like the highest tier in our program, you would get a baked in pricing incentive at closing that would allow you to, essentially put more dollars back in your pocket to not pay for the work that you had done, but help provide some incentive there. That's one of the few examples where there's an inherent sustainability only kind of pricing benefit. Again, on top of the traditional underwriting metrics and all that, for really cutting edge, innovative, sustainability type projects that we realize are more expensive, but also really good quality assets.
Yeah, that maybe, I've always been fascinated. I ran a program at Energy Star that I referred to as a mass market program. It was not the cutting edge, passive house type of program, right? We tried to do something, build something that everybody could aspire to and actually accomplish, with whatever their level of expertise was. Challenging, but doable, essentially. And I think in some way, you're exactly right, I think, about the need for education, that if anybody on the lending side even was familiar with passive house, which they wouldn't be, as soon as you explained it to them, they're going to be really scared right off the bat, right? So maybe, and I once doing work with Fannie Mae, who has their Green Rewards program, sat in a room full of lenders, bankers, and had to explain to them how to benchmark energy use in a building and how to they had to use our software tool to do that. And it was just mind-boggling to them, right? But maybe the better thing to do is, certainly people should be pursuing passive house and those really top-tier recognitions when it makes sense for them. But maybe in terms of educating people, we need to actually start more with the mass market things, the things that aren't so scary out there. Most people will be familiar with LEED in some way. There's different levels. Energy Star is a brand that 90% of people know. They don't know it's for buildings, but they know it. And they know they have it in their house. And so, you need both. You don't want to give up on those niche, those really top tier things. But to really bring along the masses and educate people who don't know, maybe that's what we need to do, is start with those more basic things.
Perfect. I think we're out of time.
Oh,
Wait, go ahead.
5 minutes.
We've got time.
I was going to say we did. So I guess just to add on, so one of the we've not seen tons of deals fly across our desk with this program, candidly, because I think by the time projects do get to us, oftentimes there's not a lot of time to make adjustments. So we've tried to educate earlier in the process, so that as folks are designing buildings, coming up with concepts, they can think about the fact that there could be incentives down the road. And we did a white paper last spring with JLL, Ryan Company, Amazon, or on decarbonizing industrial real estate. And in fact, it featured efficiency measures if you designed a property in 3 different ways, and if you wove a green lending program like ours into it. I think it's really no surprise. 80% of the efficiency came from doing 80% of the savings in both carbon and dollars came from just doing the measures and saving on your utility costs. About 20% came from the green lending program, but it was a both have been good education opportunities, not only with clients, but also internally to, as Mike said, get folks to understand what passive house even is. How much more efficient is it? What's the cost? What could be the savings? How could that factor into cash flow over time?
And I think one more to the mass market point, you can do small changes without achieving passive house that actually are very effective for the sustainability. So sustainability can be the whole building, or it can be intentional actions that are smaller but really make a difference. So it shouldn't be binary. Oh, if I can't achieve passive house, I shouldn't build this building, or I shouldn't upgrade the building. Rather, as we're looking at data centers and casinos in every asset class, what can we do to maximize asset value now and going forward? Reducing insurance premiums, reducing your operating expenses, driving revenue into the building. And that could be a small change. And that small change can be intentional. And if people understand how to replace a PTAC unit with a heat pump, and that's replicable, then that's something that people can build upon. And I think that also adds to the education, that small changes can be impactful. Because we don't want people to do nothing as a result.
Absolutely. Do we have any more questions?
I can. I am a property owner in New York, multiple buildings, and we've tried I've looked into electrifying appliances, et cetera. The grid isn't there yet. How do we handle that? I mean, we literally have been told no. How do we electrify?
Bring the first panel back.
Exactly. Sorry, I wasn't.
I mean, I don't have an answer to that, unfortunately, but it'd be interesting. Can you clarify? You said electrifying appliances, and the grid isn't there. It's there to electrify the appliances.
Well, there's not enough power to bring in for electrifying stoves, et cetera.
In your particular building.
In these 2
Yeah, so that probably needs some larger retrofits, you know, to the electrical system for the building. It's probably not a grid issue.
No, it's not just the building. Con Ed doesn't have enough power.
But they literally just told you they can't supply that amount of power to you.
And they did the same thing to us when we went from oil to natural gas, and then they built in a bigger pipeline.
Got it, yeah.
But they haven't, you know, they just don't have the power out.
Oh, and I don't have the answer. I mean, I can say that the panel this morning, you know, I think this is an issue, right? And I mean, coming from the U.S. Environmental Protection Agency, where I was in the place where we were encouraging everyone to electrify everything, which I can say now because I'm not an employee anymore. I'd get in trouble for saying that if I was.
Don't electrify everything.
No, I'm not saying don't electrify, but it is a real concern. And I had that concern that, you know, we were out there telling everyone to electrify everything, but the grid is not ready for it. That's the reality of it. And I think that's also an issue with things like Local Law 97 and some of the other laws that are pushing and are much more stringent even than Local Law 97 that will require electrification faster. They're not necessarily practical. They're not necessarily things that can happen. So I think it requires a step back and a reality check to do as much as you can and prep for the future and have that in your plans for the right time when you might be able to do that. In the meantime, there's probably some other things to do. But
Doing
yeah, well, like efficiency of the, you know, in the building that you have, but then put that in the plan for the future. Yeah, because just to bring new resources on the grid takes 5, 10, 15 years to do. And now I think with the renewables being rolled back and everything else, it's just going to be worse.